Picture the business of owning a bank. You imagine a solid building on Main Street, a handful of loan officers who know their customers by name, a quiet machine that opens at 9, closes at 5, taking money in from ordinary people at close to zero and lending it back out for mortgages at 7%. You pocket the spread. This story explains what a bank does on a Tuesday afternoon. What a bank actually represents is a legal permission slip from the federal government. This authorization allows a private company to do something almost no other business in America can legally do: take money from the public, promise to give it back on demand, and in the meantime lend the overwhelming majority of it to strangers. When you buy a bank, you are purchasing this government-backed authorization. The value sits in a license that grants the right to operate inside a unique regulatory framework, one that changes the basic math of borrowing and lending. This animated scale reveals the first mechanism of that license: a leverage machine. Banks operate at 10-to-1 ratios, holding $10 of loans and investments for every single dollar the owners actually risk. The scale is counterbalanced using subsidized funding, the checking and savings accounts sitting in your banking app. This capital is the cheapest form of financing available in the American economy. This funding remains cheap because the federal government guarantees its safety. The Federal Deposit Insurance Corporation backstops the deposits, removing the risk for the household so the bank can put that capital to work. The famous interest rate spread is the raw material fed into this machine. By applying double-digit leverage to even a modest margin, a bank generates a return on equity that can compete with private equity or the stock market. Trillions of dollars sit in accounts paying near zero interest because of switching costs. Moving your money means updating direct deposits and reconfiguring every autopay for your mortgage, car, and streaming subscriptions. Behavioral economists find that the inconvenience of leaving is worth more to most people than the interest they would gain by staying. The FDIC guarantee removes the only reason you would ever shop around. If a dollar at a sleepy regional bank is legally as safe as a dollar anywhere else, the incentive structure for consumers to move their money vanishes. While deposits provide cheap capital for lending, banks run a parallel revenue stream through fees. Overdraft charges and monthly maintenance costs generate income without requiring the bank to take on any credit risk. These fees target customers living close to a zero balance. Human psychology weights an immediate benefit more heavily than a future cost, a concept called present bias. A customer swipes a debit card for groceries today, while the bank is positioned to profit if the account math runs slightly behind the transaction. The most reliable profits flow from sitting in a structural position where human inertia on one side and fragile incomes on the other do the earning for the institution. Starting a new bank today requires massive hurdles. Organizers typically raise between $20 and $40 million in startup capital that must sit idle for years just to satisfy a regulator. Once operational, a bank faces the efficiency ratio. Roughly 60 cents of every dollar brought in disappears into the cost of existing as a regulated entity, before accounting for loan losses or owner profit. This overhead is the price of admission for the charter. Multiple layers of government examiners comb through loan files and technology systems to ensure the institution isn't being reckless with its levered assets. This heavy oversight attempts to manage moral hazard. Because the FDIC protects the depositors, the market stops policing the bank's behavior. The natural discipline that would normally punish risk-taking is replaced by a centralized, bureaucratic check. This safety net changes the cost of failure. The government socializes the downside of a collapse, creating a system that encourages bank owners to take on more systemic risk than an unprotected business ever could. This timeline reveals the core danger: maturity transformation. A short loop represents deposits, leaving tomorrow. A long track represents assets, lent for decades. This mismatch creates an interest rate trap. When rates rise aggressively, older bond prices fall, forcing sales at a loss. Silicon Valley Bank fell into this exact trap. They bought billions in safe government bonds when rates were near zero. When rates spiked and their tech industry customers began drawing down deposits to fund operations, those paper losses became real. Historically, bank runs were limited by physical friction, lines at branches and paper forms. Silicon Valley Bank's customers used digital networks to coordinate. They triggered a high-speed information cascade that moved millions of dollars in seconds via smartphone apps. On March 9, 2023, depositors attempted to withdraw $42 billion in a single business day. By the close of business, the bank's cash position had dropped nearly $1 billion below zero. The fundamental architecture of the leverage machine, borrowing short and lending long, collapsed when the stress test arrived. You can see the value of that architecture in how banks are acquired today. Credit unions are buying community banks at massive premiums, often paying over 200% of the bank's actual book value. Meanwhile, the public stock market is pricing those same banks at a significant discount. Public investors are often willing to pay less for a dollar of the bank's equity than the equity is worth on paper. Credit unions and fintechs are paying for the legally privileged charter itself. They are purchasing the scarce government permission slip, allowing them to take deposits and apply leverage without the multi-year struggle of building a new institution. Most Americans own a slice of this system through their retirement accounts and index funds. It is a fragile leverage machine wearing the clothes of a safe lending utility, and its true stability remains invisible until the day it fractures.